Hello, good morning, everybody. Thank you very much for giving up your Saturday to join me on a webinar in relation to retiring in Spain. My name is Kevin Hall. I'm a senior associate with Holborn Assets. I don't know whether you know anything about Holborn Assets, but just briefly to explain a little bit about the company I represent and a little bit about myself before we actually enter into the webinar. Holborn Assets, established in 1998. Success story really. Since starting back then, I've expanded through international waters, right the way across Europe, and have offices all the way around the world with many, many qualified advisors like myself. Each advisor is fully qualified in each jurisdiction. So each of the advice that we give to wherever you are in the world, you are fully protected under the highest regulation. So that just gives you a little bit of peace of mind in relation to the information about Holborn. About myself, I've been in the industry now 27 years. I started in the UK. I worked for numerous different insurance companies at IFA status up to manager. And then I decided when the industry changed back in the late 90s that independent advice was the way forward. And I have been an independent advisor since then. So that's a little bit about myself. So what I'd like to do now is look at the screen that we're sharing today. And you can see a little bit about myself there, and obviously the intro into retiring in Spain. So if we just move forward into the next slide, if you just bear with me a minute. You'll see there that these are all the options that you should be considering in relation to retiring in Spain. There are so many different options available, and today what I will be doing is sort of qualifying the areas of where many questions always lie in leaving the UK to come to Spain or various other parts of Europe when considering the pension options. The main options really is understanding the advantages for you and your family. A lot of people forget about the important factors here. They sort of pack up their bags, leave their family and friends in the UK, sell their houses, belongings, come to Spain, and then it's many years later where they decide, hang on, my pension. So this is why we tend to educate people to sort of not leave it too late before recognizing that you need to do something about pension planning. And in the same instance, you need to get all the facts so you can make the right decision. It's our job really to give you this information and answer all your questions that you may have and assist you and guide you all the way through, not just now, but into the future in relation to any pension that is recommended to yourself. Like I mentioned earlier, it's making sure that you gain the correct advice from a qualified, certainly in international waters, MiFID II qualification, to make sure that you're fully protected in the advice that you receive and the products that you may be entering into as a contract. It's considered that the pension is the second largest asset that you may own in your lifetime, apart from the house. And many people don't really think about that until it sort of comes up into question. It's important to really drill down the importance of your pension, because a lot of people are retired a lot longer than they actually are working. And that's an important factor, because this money has to last a long time, not only for yourself, but to leave it behind to either your spouse or children or family. The other important thing is to let you be aware of the understanding of gaining control of your pension and retirement while you're living as an expat. Because of the rules that are at this moment in time, if you have left the UK, regardless of Brexit, you are in international waters and you are no longer able to take advice from anybody operating as an advisor level in the UK. In the same way, whichever company your pension is with, which you've left behind in the UK, they will not be able to give you any advice. So you need to speak to somebody of my sort of status within the waters of where you live to gain that advice. And the most important thing really as well is understanding the full dimensions of the pension, which includes the costs, the charges, and the flexibility, and who's managing your pension. This is so important so that effectively, if you really do understand the nuts and bolts of your pension and how the mechanics work, you would be able to then feel comfortable in recommending our services to other people that may be in the same situation that you were with your pension. And again, today what I will be doing is looking at the various options between QROPS and a SIPP pension. And for the purpose of this webinar, a QROPS is a qualified recognised overseas pension scheme, and a SIPP is a self-invested personal pension. Both of these are very different for different reasons, and that's what we'll be sort of covering today within the webinar. If we just move on to the next slide. What you can see here as well is another important factor is when people move overseas, you may have been working for your working life through very many different companies. You may have changed to self-employment status, gone back into employment, and you may have joined various pension schemes, whether it would have been a company scheme, a non-contributive company scheme where you pay nothing into it, or indeed as a self-employed person, started contributing to a self-employment pension scheme. Now, on this basis, again, so many years pass, and unlike before, many people now have many roles of employment through their working career. It's not back in the day where you would finish school, you'd gain employment, and you would probably stay in that same employment role up until retirement, and there would be one pension payable. In this new modern age, it's a known fact that many people may have 10 different employment roles through their working life. And of course, if there's been a time where you've joined these pension schemes, you will forget. Now, what we're able to do is we're able to locate these old pensions on taking some information from yourself with a letter of authority to gain us the authority to do a complete search, utilizing your information that you provide us, and of course the support from the Holborn Asset Support Department, which is a support team there in the back office of Holborn, allowing us to search thoroughly through all the systems back in the UK to gain access to these pensions you may have forgotten about. We also have links with HMRC using online services to contact the old schemes by allocating their known addresses and trustees, because they would have changed over many years, so that we can actually write to the preceding schemes to gain the information so that we can advise you accordingly. When the pension is actually found, what we then able to do is to assist you in providing you with all the advice in relation to the preceding scheme of where it is. Look at the small points within the scheme, which are always in small print, which a lot of people tend to sort of skip over. This is the information that's very important to ourselves. We drill down into these small specifics to make sure that you totally understand these main points within the scheme, allowing us then to make sure that you're fully aware of the options available moving forward from where you are and obviously into the future. And don't forget, this is all your money. And unless you claim it, unfortunately, the state does have it. That money is there. There's millions and millions of pounds of unclaimed pension monies. And it's our job to assist people, like many expats, to try and locate this money and gain control for your retirement, gain the funds so that you can go and enjoy it and enhance your retirement. The process really, it takes about 6 weeks to gain the information if it runs smoothly, because there's a lot of searches that we have to do. Also, we have to rely on the preceding schemes to write to us to provide us with this information. And, it can be a short period of time, depending on which scheme you're dealing with or which trustee. And in some cases, it may take a little bit longer than 6 weeks. However, I can't emphasize enough that to be fair, it's the most important 6 or even 10 weeks of your life to gain control of some monies there that may well be lost for you and your family. If we just move into the next screen now. I'm going to cover the aspect of what we just mentioned earlier, which is the QROPS. This is an option of what you're able to take advantage of when you live overseas. And as it states quite clearly, it's a qualified recognized overseas pension scheme. Now, this is an ordinary pension. It's almost like a personal pension where you gain control and you really do have full control of the pension with guidance from an advisor like myself. But what it enables you to do is to bring it under the jurisdiction of where you're living overseas, and gain all the various options that come with it. Now, the purpose of transferring it into an overseas pension scheme is that it's recognised by the HMRC as a qualified recognised scheme. So that gives you peace of mind that the funds are being transferred from pension to pension with no third parties involved, so you're fully protected. That money would never, ever be transferred to any other third parties. And it would, it's protected by the governing regulation to make sure that doesn't happen. Obviously, there's charges and fees within this type of pension scheme, just like every other pension scheme. You may not know that a frozen pension that you may have in the UK at the moment is stagnant. It is occurring fees. You've got no control of it. You don't know where the funds are invested, you don't know who the fund manager is, you don't know what the allocated charges and the ratios are of that particular scheme. And unfortunately, depending on where those trustees have decided where they were going to invest that money, you'll only have a statement if you're lucky once a year to see if you've lost money or whether it's actually made money, because the fees will continue to increase and continue to be taken. With a QROPS, those fees will be there and they will be taken. However, you will have the guidance from ourselves where we can manage between both yourself and the client to manage the funds and allocate them to your risk profile, to making sure that that pension and that money does work to your advantage up until the time when you take it. Unfortunately, with this type of scheme, you will not be able to make any further contributions to the scheme because the scheme becomes closed. However, you have 24/7 access to the pension, where you can monitor the statements, the funds, and also one of the most important factors of this particular scheme is both spouse and children, family, upon your death, would receive 100% of whatever the fund value is at that particular time. Unlike in the UK, whereas if the pension fund is left in the UK at the moment, unfortunately, 50% of those funds would only be payable upon death, and the remaining 50% would be payable to the HMRC. So that's one benefit of considering option of transferring to an overseas pension scheme. Another benefit, as it states here, there's no death tax payable by the beneficiaries after the age of 75. So effectively, that inheritance of the pension, which sits outside the estate, would not occur any charges of tax and would be paid as a whole either to the spouse, and if the surviving spouse is no longer with yourself, then the 100% would be payable to the children. And again, that would not happen with the UK pension under UK pension rules. In fact, the children receive nothing and do not get any pension payable in the way of benefits in the event of any death of a pension. The reason why this works is the pension is placed under a trust, and this trust protects the whole pension fund as a wrapper. So effectively, that when that person dies, the wrapper that wraps around that pension within a trust actually sits outside of the estate of the person who has died. Again, using HMRC approved schemes, this has all been passed off by the regulator to make sure that this is obviously all above board and regulated to the highest degree to make sure that both the individual is protected and also the family. Another good thing with this particular type of scheme is that you've got loads and loads of flexibility. Although you can't pay into the scheme, what it will allow you to do is after you've taken your 25% tax-free lump sum at the time of when you decide to do it, that's not the only lump sum that you can take from this pension. You can consider yourself very lucky by enabling to access the pension later in retirement years. If you hit on hard times and you need a cash injection, you can also withdraw further lump sums from that pension fund. But of course, it will be taxable because you've taken the 25% tax-free lump sum earlier on. Then effectively you will be taxable, whatever your rate is in the jurisdiction that you are, as it will be classed as income. Now, I don't know whether you know, but this is an important factor. People that have completed a full 5 years of residency and tax overseas, you can actually be allowed to draw up to 30% as a tax-free lump sum, as opposed to the standard 25% tax-free allowance under current rules. Those rules may change, but at this moment in time, those rules are applicable. So that's another stipulation there that comes into consideration for those people that are not looking to take their pension for 5 years and over while they're living overseas. Now then, if we convert that to looking at the option of a SIPP, which is, as I said before, self-invested personal pension, you'll see by running through the list here very quickly that the options are very similar, but they are very different. Yes, the transfer to be able to transfer your funds to an overseas pension utilising the SIPP is very, very much the same as a QROPS, and it's regulated and it's protected by HMRC, and it's been signed off in various trusts and trustees via the HMRC providing the scheme is regulated. However, the charges and the fees are lower with this particular scheme for each individual. And the reason for that is the concept of the scheme in the way that it's made and the way that it's developed is a lot cheaper. Obviously, those costs that are reduced are passed on to each individual. Also, with this particular scheme, you can add further contributions to enhance the pension for anybody that's wanting to do that, rather than take the pension immediately, or indeed defer the pension for a considerable amount of time and are still working overseas. That's a nice option to have to enhance the pension for later life. Just the same as the QROPS, the same benefits apply, with the spouse and the children receiving 100% of the funds upon death, and obviously receiving all those benefits and not have to pay tax. Again, it's protected by a wrapper with the trust, which is approved by HMRC within the UK. Slightly different on this particular scheme, where there's no death tax paid on the beneficiaries up to the age of 75. So after the age of 75, the rule of taxation would apply. Again, if you wish to access the pension and receive more funds from your pension throughout your retirement, again, you can draw down as many times as you want, as long as the funds are there, of course. And then those funds would be taxable at whatever your annual rate would be. So again, it's a consideration of flexibility is there. It's nice to have that. And if you don't need to, you don't have to take it. But of course, if you do hit hard times, just like having the QROPS, it gives you that amount of flexibility of knowing full well that you can draw upon some cash if needed. Unlike the QROPS, this particular type of pension, and if you were looking at further different types of investment to enhance your pension years as further income, to let out property or various things like that with a commercial investment property, you can actually use your SIPP pension as collateral in relation to either borrowing funds or indeed funding this type of investment. And what you've got to consider really is when you look at commercial pensions and group pensions, majority of the monies are invested in property anyway, so it'd be very much the same. Difference is it's your pension and it's your property that you would be investing in, so it's set up in a similar sort of way. Difference is that it's yours and not a group. And again, the same 5-year stipulation rule applies with this particular pension. Again, if you've completed the full 5 years as a tax regime and residency overseas, you can then draw up to the 30% as the tax-free initial lump sum, rather than the standard 25% tax-free lump sum. And again, I must emphasize, that's the current rules at the moment. These rules may change, like pension rules change all the time. It's our job to keep you in line of these changes and guide you through when they happen, and to make sure that you're fully aware of them, and also your circumstances are protected if any changes are to be made. Okay, now there's another pension that you may not have heard of that does actually come to light when you're overseas, and it's called a QNUPS. Now, QNUPS is a type of pension really for establishing mitigation of taxes. Normally, this would be structured in relation to high net worth clients with huge or certainly larger pensions, whereas what you're trying to do is protect the whole asset in relation to moving forward into your retirement and taking advantage of the tax rules that are within the QNUPS pension schemes. Very similar to a QROPS. And the only difference is with this particular type of pension is that it becomes more structured in relation to tax. So for looking to tie in existing property, individual assets that may be accepted, that's something that we can apply for at the time of an application, and they can all be added into the pension as one fund. Of course, there may be cash in there already, but the valuation of properties or indeed existing pensions or fixed assets can then be all brought together to make sure that you get that full tax advantage. And what I mean by that is that if people have got a property, say back in the UK, they've not sold for, say, I don't know, 500,000 as a figure, they may wish to add that to the pension. So it becomes part of the pension for while it's there as an asset. They may have a wine collection, valued artwork that, again, along with cash in the bank that's just sitting there, that they long term they can afford to not be able to access it, can also add this to this particular type of pension fund. Now, on the basis of that, again, with all these elements being part of the pension, there's the main reason of doing this is there's no inheritance tax payable to the spouse or indeed the family. And this is because, again, of the trust. Everything would be implicated into a trust. It would then not form part of the estate on death, so therefore there's no inheritance tax payable. The inheritance tax rule in the UK at the moment, if you had that £500,000 property and you had other assets and it took you up to £1 million, say, as an estate worth at the time of death, then obviously there's a huge allowance there where there's tax going to have to be paid on inheritance tax, and it's at a rate of 40%. So anything above the 395,000 threshold is liable to 40% taxation. And of course, upon death, the family would have to raise that 40% first to pay the tax to HMRC before the estate would be released. So what normally would happen is that the family would have to go cap in hand to the bank with the proof of the asset funds and obviously the estate, proof of death certificate, to explain the fact that obviously the estate is not going to be released until the tax is paid. They would take a loan out to pay whatever that tax bill is, and then obviously on completion of the estate, or when it's completed with all the legal team, the bill then to the bank would then be satisfied. But what you've got to bear in mind is that if the fund is mitigated within the QNUPS and put all into that pension, there wouldn't actually be any tax payable. So you wouldn't actually have to go to a bank to borrow the 40% or any of the monies that would be payable. There'd be no tax payable. So it's a huge benefit for anybody that's got quite a large estate looking to protect their family in future years. With this particular scheme, because of the tax that's implicated within this, you will need to inform HMRC if you stop being an expat. So every 5 years that go by, if you're in the UK, if you're overseas, then you would just basically confirm you were still overseas. And if you weren't, you would have to let them know and make them aware of that. And this is obviously within rules, using the form as listed here, which we can assist our clients with if needed, but it's accessible on the gateway with everybody's HMRC allowance password that you're given if you set up your own account with HMRC. And you can download this form, either print it and email it or send it in the post, or indeed you can use the online system through your security gateway password, and you can submit the form direct if it's needed. Again, with this particular scheme, it's highly regulated. It's all administrated and approved by HMRC. And when you have this type of policy, you have to make sure at every status that it's administrated within the rules to make sure that there's no hiccups later on down the line. Okay, that covers the aspect of pensions. I think hopefully I've answered some of your sort of questions that you may have had today. As the slide here comes to the end, it does highlight the fact that there is light at the end of the tunnel. You've just got to be able to ask somebody like myself for guidance and assistance with something as complex as pensions. You'll see there that just with the bullet points that I've gone through, it's quite complex. There are a number of different questions I'm sure that you may have. They may all be different questions. There is obviously a link for you to contact, and you've given us your details already in relation to your contact details, of which any questions that you have, we will be able to contact you and hopefully assist you further. And I will look forward to doing that personally and speaking to you all in the near future, if and when I can help you. Thank you very much for your time today, and I would like to wish you all a nice weekend. Okay now, goodbye.